Okay, hello everybody. This is the discussion for Chapter 14, dealing with money creation. I think you're going to find this a little bit more straightforward, not quite as long, but it does sort of give you a bit of an introduction to how money creation happens, at least from the standpoint of the private sector. Remember, we talked early on in week one about private sector versus public sector. Private sector being those for-profit entities that do what do they do? They do it for their own particular interests. The public sector being government, and we're going to see how both today, in terms of private sector money expansion, it's done, but also on Thursday of this week, week 7, we'll talk about the idea of public expansion through our central bank, which we've talked a little bit about, but not very much. So, real briefly, we're going to talk about money creation. Now, by the way, this is a pretty good segue into where we're going to go on Thursday, because I think it's important for us to realize where money comes from and how it is created, how it is actually destroyed. And I know the idea of money destruction sounds completely insane, but we're going to talk a bit about what that's about, okay? And we'll also get into, on Thursday, some issues with regard to how monetary expansion sort of multiplies on itself. And there is a monetary multiplier. It's the only other multiplier that we're going to talk about in this course, how it can expand over time as banks particularly lend money. And we're going to take the idea of banks as a euphemism for really all of the financial services companies. The banks have a unique role to play. And we're talking about primarily commercial banks, but it can also involve savings and loans, credit unions. The key thing is I think these are depository institutions, and they play a unique role in the economy. And one unique role is this idea of, from a macro standpoint, monetary creation. And this is one reason why, because the role is so important, why banks are so regulated and so looked after and scrutinized by government. And by the way, I know that, in my lifetime, we've had about 2 or 3 financial crises where the banking industry has been in trouble, and the government has stepped in to stabilize things. And some of the criticism from some quarters in our society are, oh, you're going to bail the bankers out, but what about our bailout, that sort of thing. And it's not done to bail the bankers out. It's done to bail us out, the entire economy. And by the way, some of the bankers themselves are wiped out. Their shareholders are wiped out during the financial crisis of 2008, 2009. If you were a shareholder of Lehman Brothers, you went down to zero in your investment, or Bear Stearns, or a lot of the companies that failed during that period. Most of which were investment firms. Some of the banks, for the most part, survived, and they were absorbed by other banks. And there's a lot we could get into with regard to bank regulation. And some of this I've sort of alluded to before. It's probably best covered for those of you who want to be finance majors at some point. You'll probably come to this at some point, okay? But what I want to do is sort of focus on the role of banks, depository institutions, in creating money. So when we say money creation, we're talking about private banks lending activities. That every new loan becomes new money in the economy. And that sounds completely crazy. It's I know when I first read about it as an undergraduate years ago, I thought, no, that doesn't make sense. Can't be. It's too miraculous. It's too easy. But in reality, that's what's going on. Now let's talk about a balance sheet. So I know that you've had some accounting. I believe you have, at least. I don't teach the accounting courses in the fast track program, but as a general rule, from a very basic, and I realize this is not you can't pass the CPA exam with any of this. The assets, we're going to talk about assets and liabilities. Assets are things which are owned. That's not exactly the, according to Hoyle definition, but that's a pretty good definition. Resources which are owned or controlled. And the big thing is they control loans and investments, but also what we call reserves. And I'm going to talk about reserves here in a minute as to what those are about. And then liabilities are things which are owed, okay? And they include bank deposits. And by the way, if you're a depositor, you certainly hope that your bank treats that deposit as a liability, that is, they owe it back to you, whether it's on demand or at a certain point in time, whatever. And also loans from other banks and the long-term debt they've got, those sort of things. But here's the thing that we should talk about, is the idea that, let's talk about deposits, and how deposits go from deposits to becoming loans. And there's a step involved here which involves reserves. Here's the interesting thing about banks, and why it's sort of amazing to some people that bankers could ever mess this up, is the idea that somebody brings a bank deposit. It's simultaneously an asset and a liability. And the asset is a reserve that belongs to the bank. You are turning over legal title of that money to the bank. All they have to you is a liability to pay it back to you, whether it's on demand through like a checking account, and we'll talk about what those divisions of bank deposits are on Thursday, or over time through like a certificate of deposit or whatnot. They went back to you, but the money is theirs to control. It's a reserve. Yes, there are legal restrictions on what they can do with it. They can't, gamble in Las Vegas or whatever. They're pretty much restricted to loans and investments. Loans and investments are the big things which they're sort of stuck with in terms of assets. But when they make loans, though, they actually create money in the economy. Okay, so that's what's interesting about banks is it's a fairly unique role. Every time you make a bank deposit, you create both a reserve and a liability. Which, in other words, the reserve is an asset and the deposit is a liability. So you create things on both sides of the balance sheet, and we'll talk about what that looks like. So I've got a hypothetical example of a very, very simple economy of two banks, first bank and second bank. I stayed up all night thinking of names for these banks, and so we've got $100,000 on deposit at the first bank, $100,000 on deposit at the second bank. And by the way, these look like T accounts. If you take an accounting course where you get a T accounts, you have debits and credits. This is not a T account. I'm just simply dividing assets and liabilities. That's really what's going on here. And I'm not even including shareholders' equity. This is not an accounting course, and it doesn't really serve our purpose to get that detailed with this. And in fact, a lot of textbooks get much more detailed in terms of things like required reserves that are deposited at the Federal Reserve. We're not quite there yet. And we're not really going to get that deeply into it in any case. So in this case, what do we have? We have $100,000 on deposit, and which creates a $100,000 reserve, because remember, every bank deposit creates an asset as well as a liability. It's a liability in the sense that the bank goes back to the depositors. But it's also a reserve. They can do whatever they want. They can make loans, they can make investments, whatever they want to do with it, right? That's legal, okay? And so together, the money supply is $100,000 at the first bank and $100,000 at the second bank. So the money supply is $200,000, okay? All right, so pretty straightforward. I know that sometimes economists like to sort of dial these down to make these ultra simple examples, but I think if you take the logic of it, it should make sense as to what's going on. So let's do one scenario. We're going to do two different scenarios to sort of describe what's going on, particularly in terms of the credit function, how the credit function ties into the deposit function in order to create money. So the first scenario is, let's say the customer at the First National Bank writes a check to a customer of the Second National Bank for $20,000. Okay, so the First National Bank customer is going to write a check for $20,000. So their deposits are going to go down by $20,000. The percent of the parentheses indicate negative, and so deposits go to $80,000. It's also, they're going to pay it out of their reserves, and so reserves go down by $20,000. And so as a result, we get $80,000 in both reserves and deposits. Okay. And then over here, the customer in the Second National Bank makes a deposit of that same $20,000. So deposits go up to $120,000, and reserves go up also by $20,000, because now that bank has $20,000 in new money that it wants to have. Okay. And so they get to use it. So as a result, what's the change in the money supply? Just from clearing your check. Okay. And so we have the First National Bank, which now has $80,000 on deposit, and the Second National Bank, which has $120,000 on deposit. So as a result, we have $200,000 as the money supply. The money supply is unchanged, and so this idea of moving deposit money around doesn't do anything macroeconomically at all. This is not a function of the macroeconomy. It's not a driver of the money supply or anything like that. Instead, so just simply moving money around doesn't really help banks. Banks would love to have more on deposit because it gives them more reserves to deal with, but they've still got to honor the obligations to their depositors, and that is far and away, the preeminent obligation that banks have to customers is to honor deposit obligations. So when banks are struggling, maybe because they've impaired their reserves somehow with bad investments or bad loans, which is often, or not often, but sometimes a problem, it can impair their ability to honor obligations, which to depositors, which is why we have FDIC insurance and all those things which go along with it. So for those of you interested in banking, there's money in banking course that I think is really interesting in that regard. So, all right, so that's one scenario. Let's take another scenario. Let's say a customer of the First National Bank borrows $50,000. Okay, all right. And let's say it makes its way over to the Second National Bank for whatever reason. So now we get a loan because the loan is an asset, right? So $50,000 is being borrowed, okay? And so as a result, assets go up by that, okay? And as a result, so do these deposits. So as a result, deposits go up to 130, right? But keep in mind that what's going on here is that nothing has changed with regard to the money supply. Okay, the bank has simply funded this by taking $50,000 out of reserves. Okay, leaving the $30,000 in reserves, but deposits are unaffected. In fact, deposits go up. All they do is go to the bank and say, "I want $50,000." Okay, boom, it's your checking account, and the money supply goes up to 130. But nothing's happened over here to this other bank at all. So as a result, what's going on here with the money supply? We have the First National Bank, the money supply there is reflected deposits is 130, and the Second National Bank is 120. And as a result, what has happened is the money supply now goes to 250. The increase is 50,000, and it's entirely due to the $50,000 that was borrowed, and every dollar borrowed becomes new dollars in the economy. This is something that is mind-blowing in a lot of ways, and that is every time somebody borrows money from a depository institution, it's brand new dollars that never existed before in the economy. And you might think, well, wait a minute, banks have been lending money forever. And so why does the money supply just go up and up and up and up and never stop? Well, it does, sort of. But here's the thing. If this borrower were to repay the $50,000, everything goes back in reverse. And that's called money destruction. Repaying debt to a bank is the same as taking money out of play in the economy. Because what you would do then is you'd simultaneously reduce your liability and the asset. This would go down, this would go down, and you would shrink the money supply as a result of that. So when the Federal Reserve, which is our nation's central bank, which we're going to talk about on Thursday, when they want to expand the money supply, one thing they try to do is to try and make it more appealing and attractive and affordable for borrowers to borrow money. And so as a result, every act of borrowing money increases the money supply. So if they're trying to boost the economy, they want to put more money into play. Now they can do it on their own, and the Fed certainly has the capability of doing that. But it may become slow. It doesn't really work its way through the economy. This has immediate effect. What is somebody borrowing $50,000 for? Maybe to buy a vehicle, maybe to pay off payables to a supplier. I don't know. It doesn't really matter. In fact, it makes no difference whatsoever, as long as the money gets spent. As long as the money gets spent, it creates more money in the economy, which creates more demand for goods and services, has a ripple effect through the economy, and we'll talk about the multiplier effect more on Thursday. But that's what will happen when there's an encouragement of borrowers. It creates money supply. Yes, the government can create money on its own, but it doesn't always transmit throughout the economy. This is much faster. On the other hand, when inflation is raging, and as it was in the late 1970s, the government can sometimes put a crunch on money and say, all right, you know what, we're going to discourage you from lending money. We're also going to raise interest rates so that, number one, it's going to discourage borrowing because the cost is so high. Number two, it's going to disqualify borrowers. Some borrowers can't qualify when rates are high because they simply don't have the wherewithal to service the debt. So as a result, everything unwinds in the other direction. And as a result, we dial down both liabilities and assets, shrinking the money supply. So, and that's really where we're going to be going on Thursday when we talk about what the government's actions are. But this is a very simple example. And I know that some of the examples you can see, and I know sometimes students will sort of, Google money creation and bank lending and all that, and you get all kinds of different examples of required reserves and whatnot. We're not really going to get into that. In fact, required reserves right now at the moment is zero, so it's not really even that relevant of a concept. Or get into things like interbank borrowing. Let's not complicate our lives in that direction. We're only going to focus on the idea that every time a bank makes a loan, it creates a new dollar. On the other hand, every time somebody repays a dollar, it's a dollar out of play in the economy. And you might say, well, it's out of play, but it's back in reserves, right? If somebody pays this $50,000 off, simply $50,000 goes back up, right? That's true. But how long does it take for that bank to find a new borrower or to find an investment opportunity to channel it back into the economy. One thing I can tell you is sometimes banks don't want to lend money. It happens, and I've been there as a banker myself. Sometimes banks really want to put the lid on banking, and so you really can't make banks lend money if they don't want to. And this was sort of reaffirmed back in the financial crisis when the Treasury Secretary, John Snow, was asked why banks weren't lending money, because they weren't. And he said, I can't make banks lend money if they don't want to. And so if banks don't want to lend money, they don't have to, right? Now they can't do something stupid like say, I'm not going to lend money to you because of whatever characteristic you might have. There are anti-discrimination laws. They can't do that, and they won't do that. In fact, I've never, in the 19 years I was banking, ever even heard of somebody doing that. But if it's a legitimate request, they have to honor it. But they may price it so high that people are discouraged from doing it. And when I say pricing, the interest rate may be a deterrent just in its own way. So this is sort of the process of money creation. Every dollar loan becomes new money. Who's the money supply by the amount of that loan itself? And as loans are repaid, it goes in the other direction, it sort of repays it. So as the economy grows, people demand more credit. For what? Businesses demand more credit to buy inventory, equipment, and new facilities. People borrow money to buy homes and to go to college and finance that, vehicles, all these kind of things. And so the credit function is important. And I know that we want to sort of distance ourselves from the idea of thinking that maybe borrowing is bad, it's negative, because we're going to make the case that if you want to stimulate an economy, one way to do it is to encourage borrowing, because it puts money into play in the economy. And there's no stigma, I think, that should be attached to borrowers, because most of us in our lives are borrowers at some time. Most of us cannot afford a house unless we borrow money to do it. And so as a result, we'd have no housing industry if there weren't finance available to do it. So there's an important role that banks play in this process. And you can read more about it in chapter 14. I think it's an important chapter. It's pretty brief. I don't think it's going to take you a long time. It goes into some areas that we're probably not covering here because I don't think it really is that important where we're going. But I do think this chapter is important as a jumping off point for where we're going to go in week 7, which is our final bit of discussion. So, and if anybody has any questions about this or the other video before that, feel free to get with me. And I'll be more than glad to sit down with you and talk about it. Otherwise, I'll see you on Thursday. All right, have a good one.